Welcome to The Explainer. Today, we're going to dive into a real puzzle that's shaking up the Bitcoin market. We're talking about a long-trusted price rule that, well, it really looks like it's breaking down here in 2026. Okay, so let's get right into it. You see, for more than a decade, there's been this one simple, pretty reliable belief in the crypto world. Bitcoin's price just can't stay below the cost to produce it for very long. But right now, we are in a situation that is challenging everything we thought we knew about the market's fundamental economics. So historically, whenever the price dipped underwater like this, these moments were always super brief. Think of them as quick little market resets. If you look back at this timeline, in 2015, it was barely over a month. By 2022, it stretched out to 4 months. But now, we are completely sailing in uncharted waters, folks. We're well past the 5-month mark, and honestly, there's no clear end in sight. So, to really understand why this is such a huge deal, we've got to look at the hard numbers. Let's break down exactly what it costs to create one single new Bitcoin as of April 2026. Now, what's really fascinating here is that pretty much everyone agrees. We're not looking at some wild guess. You've got major players like JP Morgan, you have data platforms like Macro Micro, and they are all landing on basically the same number. This isn't some niche theory. It's a widely accepted fact that the average cost to mine a Bitcoin is hovering right around $80,000. And this is where the math gets pretty painful. While it's costing a fortune to produce a coin, the market is only willing to pay about $65,000 for it. You do that math, and you realize the average miner isn't just missing out on some profit. No, they're actively losing a staggering $10,000 to $20,000 for every single Bitcoin they create. I mean, that is the very definition of unsustainable. Or at least it used to be. But hold on a second. Isn't the Bitcoin network designed to fix this all by itself? It has this built-in survival mechanism that for years has worked flawlessly. So let's take a look at how it's supposed to work. So, the network's secret weapon is this thing called the difficulty adjustment. A good way to think of it is like an economic thermostat for the whole system. It's a really brilliant piece of code that's designed to keep the network healthy and prevent exactly this kind of situation we're seeing today. And it's always been this elegant 4-step dance. When prices fall, the miners with higher costs, the less efficient ones, they start losing money and they have to shut down. With less competition online, the difficulty automatically adjusts downward, which makes it cheaper for the miners who are left. This brings the cost of production back in line with the price, and the whole cycle starts over again. So here's the billion-dollar question. If this self-correcting system is so effective, why on earth isn't it working now? What is so different about 2026? Well, it turns out there's a powerful new player in the game. You have to remember, in every single previous cycle, the choice for a miner who was losing money was binary, and it was brutal. You either turn off your machines to stop the bleeding, or you go bankrupt. There was no plan B. But today, that has fundamentally changed. Instead of just shutting down, miners now have this incredibly lucrative alternative. They can pivot. They can take their most valuable assets, we're talking massive data centers and access to cheap power, and rent them out to a new, even hungrier customer. And that new customer is the artificial intelligence industry. The reason for the pivot is just simple economics. Right now, the money that miners can get per kilowatt hour by powering AI computations is significantly higher than what they can get from mining Bitcoin. It's really a no-brainer. And look, this isn't just a theory. This is happening at scale. The biggest publicly traded mining companies are actively rerouting their power away from Bitcoin. And this allows them to survive the downturn without shutting down their operations. The consequence of that? The network's hash rate, the total computing power, it doesn't drop like it should, and that keeps the mining difficulty stubbornly, unnaturally high. So what does this new reality mean for the future of Bitcoin mining? The rules of the game have been completely rewritten. Let's break down what it actually takes to survive in 2026. Survival is now basically a 3-legged stool. Having access to ultra-cheap power is still by far the most critical piece. But it's not enough anymore. You also need the absolute latest, most efficient hardware, like the newest Antminer series. And finally, that third leg. You need a smart diversification strategy, an AI pivot plan, B, to get you through these storms. So where does this all leave us? Well, that old rule isn't completely dead, but it has been fundamentally changed. The cost of production can still act as a floor, But the AI industry has essentially propped up that floor, allowing the price to stay below it for far longer than anyone ever thought was possible. And this brings us to the final, and I think most critical question for anyone watching this space. Knowing that the old safety net has changed, does this new reality alter how you think about investing in mining companies or even how you decide on the right time to buy Bitcoin itself? It really is a new world, and the old maps may no longer apply.